don't want to leave them underprotected. The older you're getting, the lesser financial dependence you have. Walk into a bank and say, I have 2 crore, I want an FD, and look at the line of employees that comes to you.
I know, yeah. Is there a way to beat inflation with your term coverage? So 5% of inflation gets cancelled out with 5% in the FD. That is basically our approach.
A family of 3 can live very comfortably in 30,000,
Yes.
but a family of 3 can also need 2 lakhs to live comfortably.
Hi folks, welcome to Ditto Insurance. Today we are diving deep into one of the crucial topics when someone gets a term insurance, that is how to choose the right term coverage. Joining us today is one of our senior advisors at Ditto, Sushant. Welcome Sushant.
Thanks a lot.
Now Sushant, to start off, in the context of term insurance, can you explain what term coverage is?
So I think this means the value of protection that you're going for, or the amount that you're insuring your life for.
Okay.
Meaning you buy a term insurance or a life insurance of 1 crore, that's the term coverage we talk about.
Okay.
1 crore being the coverage of protection here.
Okay. And why is it so important to choose the right term coverage amount?
Well, look, we're buying term insurance to secure our family in case of an unfortunate event, right? Where the person who buys the policy, if something were to happen to him in forms of a premature demise,
Correct.
this is the money that he's going to leave behind for his family to financially sustain themselves.
Okay.
Now, this is important because you don't want to leave them underprotected, right? You don't want to leave a lesser amount than they might actually need.
Correct.
And here you have to factor in not only their daily expenses and necessities, but also big expenses that could come up in the future, like their kids' education.
Right.
Right? So you would want to take care of all possible scenarios that you would have taken care of yourself if you were to still stick around.
Makes sense. Now, when someone gets a term coverage or when they want to decide on the term coverage amount, there are some factors that might play in.
Right.
So, can you list them out for the ease of us?
Look, so it starts with obviously there's a maximum limit set by most companies.
Okay.
Most insurance companies let you take a maximum multiplier which is decided based on your income.
Okay.
As well as your education qualification, your location and so on.
Okay.
So they come up with a maximum multiplier saying that look, if you're between the age of 18 and 35, you're a graduate, you're making a decent amount of income, you can buy 25 times of your annual income.
Okay.
That's the maximum limit. So let's say if someone makes 10 lakhs per annum, he can get a 2.5 crore term insurance.
All right.
And at the same time, someone making good income, like let's say 40-50 lakhs per annum, he could get 10-12 crores of an insurance.
Right.
Plain and simple, it's a multiplier. Two, the older you get, the multiplier reduces. Let's say once you cross 35, you're now 36 to 40, the multiplier comes down to 20, goes down to 15 and so on. Logic being, look, the older you're getting, the lesser financial dependence you have. Right? Your kids are now older as well. And two, you've been building your savings corpus as well.
Exactly.
So the insurance company is trying to mitigate their risk to a certain point.
Understood.
That, look, we don't want to be over-insuring people out there.
Yes.
So that's kind of how they do it.
Makes sense.
Now, this is the maximum limit that's set. Coming to how we would recommend somebody to consider, this is not exactly looking at your income.
Okay.
Ditto's come up with a very unique method where we look at a person's expenses.
Okay.
Logic being that, look, that's what you're giving to your family at the end of the day on a daily basis for their survival.
Right.
Right. So we factor in things like, your food, rent, clothing, education, basic necessities of life. Right. We take that as per today's standards.
Okay.
Now here we've considered the standard of living that you wish to provide for them.
Correct.
A family of 3 can live very comfortably in 30,000,
Yes.
but a family of 3 can also need 2 lakhs to live comfortably.
Yes, it
Depends on your kind of point of view.
Correct.
So that's the first benchmark we set. Secondly, we factor in inflation.
Okay.
I'm buying term insurance for the next 30-40 years.
Okay.
Right? Suppose 50,000 is good enough for them to survive today.
Right.
I don't think they can sustain the same lifestyle even next year with 50,000.
Yeah.
Right? Everything's going to cost me 7-8% more maybe.
Correct.
Right? If I look at just CPI index inflation. So that's something we factored in.
Okay.
Secondly, we also look at it that, okay, let's say something happened and someone's family got the payout of 2 crore, 3 crore.
Right.
What do they do with it?
Right.
Right. So most users, what they do is, because I think our dependence as well, right? When they're in a situation like that, their breadwinner is no more and they now have a lump sum like this.
Yes.
There's a bit of fear there. Right.
Correct.
So what they do is they keep the money in their bank or they just keep it in their house and spend from it.
Right.
Which is a sensible thing to do, right? You don't want to take any risks with the money, you don't want to invest it somewhere and so on. But what we thought of was, look, why not at least open a fixed deposit in the bank? It's safe, it's easy, it's convenient. You don't need to be the most financially literate to do that.
Right.
Walk into a bank and say, I have 2 crore, I want an FD, and look at the line of employees that comes to you.
I know, yeah.
So yeah, that way at least you've got a lump sum lying in the bank and you're generating 5-6% of interest every year.
Understood.
On a 2 crore corpus, 5-6% is 10-12 lakhs every single year. So that way a family is getting in a steady source of income every month, and they also have a lump sum in the bank for emergencies.
Makes sense.
So these are a few things we factored in. We came up with our own sort of NPV calculator to kind of give you a very accurate suggestion.
That was interesting. Now, what about the future scenario? Example, children's marriage, education. So how should an insured person treat these events to select the right term coverage?
Right, so I think if you take Ditto's method of calculating the cover amount, where like I said, you just look at basic monthly expenses and you factor in inflation, you factor in returns, you'll have the cover amount which will just take care of this component.
Okay.
Now what you're mentioning here are lump sum expenses that it's a bit difficult for me to even estimate, right? How much do I set aside on a monthly basis?
Right.
And then how does the inflation factor in there? How does returns factor in there?
Correct.
So what a lot of people do is, let's say, suppose Ditto recommends based on all the methods I mentioned, if we recommend that you need a 2.5 crore term insurance.
Okay.
A lot of users prefer adding lump sum amounts over and above that. You're saying 2.5, I'll go for 3.5.
Okay.
50 lakhs extra for my kid's education, 50 lakh extra for his marriage.
Okay.
They kind of take buffers that way.
Right.
So there's no one fixed solution for this.
Okay.
Right. In fact, a lot of people also say that, look, you know what, I will have some savings or investments at least. Right. When I started my career, I did start my mutual funds and all of that.
Okay.
So maybe that money can help out in the future. Right?
Definitely, yeah.
It's not that the family won't have anything at all.
Exactly.
So like I said, there's no one fixed answer for this, but it comes down to your peace of mind at the end of the day.
Correct. Yep. Talking about peace of mind, something which takes away the peace of mind, which I can say are loans. And it becomes even more cumbersome when you've passed away and you have a loan lying over your family's head.
True.
Now, how should one be prepared for this? Again, in the context of a term coverage.
Fair. I think, look, thankfully these days you don't get unsecured loans. You walk into a bank, every bank will try to sell you an insurance with that loan. It's called loan insurance.
Is it? Okay.
Exactly. And it's essentially a life insurance against the loan, plain and simple. But it works a bit differently, wherein its value keeps diminishing as the loan diminishes as well.
Okay.
And the tenure is limited just to the loan. So if you've taken a 20-year loan, it's just a 20-year insurance against that.
Okay.
So in case something were to happen, the loan kicks in and the insurance is taken care of. The burden doesn't come onto the family.
That's interesting.
So thankfully, that's something that's there. Although if it's an unsecured loan, then yes, similar to the previous approach of adding a lump sum to your term insurance, the family can do the same thing. Or the insured person, when he's buying the plan, suppose he wants to go for a 2 crore insurance and he has a 50 lakh unsecured loan as of today. You take its value as of today and you buy a 2.5 crore insurance.
Understood.
So assume the worst case scenario that something happens tomorrow, 50 lakhs is cleared and 2 crore helps them sustain with their daily expenses.
That makes sense. Now, talking about premiums, let me present a scenario here.
Sure.
Now, suppose I am able to afford a term coverage of 5 crores. That is, I'm able to pay a huge premium.
Okay.
Is there any reason why the insurer will say, no, I will not give you a 5 crore coverage?
Right, so there's a good reason why most insurers won't let you take that much term insurance. And I think that comes to the discussion that we started with, right? That it's decided based on the income that you're earning.
Yes.
So how it works is life insurance is looked at as a basket or a risk pooling of sorts.
Right.
Where insurance companies calculate that if 100 people are buying a plan, what's the probability of something happening to them, right? And how many is the kind of percentage that we're looking at.
Correct.
Which is decided based on mortality rates, the risk profile, their profiles in terms of lifestyle habits and everything.
Okay.
Then it finally boils down to, okay, maybe let's say it's 4 or 5% of these users are where we might have to pay these premiums.
Okay.
Might have to pay out the cover amount.
Correct.
So if it's 100 people buying, the insurer calculates that, okay, 5 people will have to pay out whatever lump sum it is.
Okay.
The remaining 95 should continue paying their premiums so that it's a profitable business for the insurance company.
Correct.
Right? That's essentially how risk pooling works.
Correct.
Everyone putting the money into basket, and at the end of it, the basket going to just a few people.
Understandable. Yeah.
So the insurer does the math there that, look, they do a reverse calculation of sorts. That only if your income is so much, then you're eligible or you'll be in a position to pay these kinds of premium.
Right.
And the 5 crore plan wouldn't come at a very low cost, right? It does cost you a decent amount to kind of in terms of premiums every year.
Understood.
So essentially it's a risk pooling of, a reverse calculation of the risk pooling that they do.
Now, Sushant, is there a way to beat inflation with your term coverage?
This one's interesting. So you do have a type of a term plan called an increasing cover term plan.
Okay.
Where you buy a 1 crore plan and over the next 20 years, it will increase by 5% every year and essentially reach 100% capping, which is 2 crores.
Okay.
So this is one method you could take. The problem or drawback with this plan would be that you're going to be paying a slightly higher premium from day one.
Okay.
In life insurance, premiums are locked in.
Okay.
So the premium wouldn't adjust for inflation. That
Right.
would stay fixed at a certain amount, which is a bit higher.
Correct.
And two, essentially you're factoring in that, look, 20 years later, I want it to be 2 crore.
Okay.
As of today, 1 crore might be enough. So there you're kind of playing around with when the unfortunate event might happen, how much money your family might need at that point in time, and so on.
Correct.
So maybe for that reason, I don't think it's the best option.
Okay.
And two, you could always look at Ditto's method, right? Where
Yes.
we factor in the inflation into your expenses.
Right.
That's the benchmark we set. We take care of inflation. In fact, we do it at about 5% as of now.
Okay.
Considering that today the inflation might be, I think, 7-8%. But over a span of 40 years and the country is developing, we do feel that it might come down and even out somewhere at 5%.
Okay.
So that's the benchmark we've set.
Right.
And we've already taken care of that.
Right. So 5% of inflation gets cancelled out with 5% in the FD. That is basically our
Pretty
approach,
much,
right?
yes.
Okay. Now, I wanted to understand if there are any riders which can help increase the term coverage. Are there any riders like that?
Right. So there is one which is known as life stage benefit.
Okay.
Now this is a free rider. When you're buying the term insurance, you don't need to pay for this rider.
Okay.
It's either included in your plan or it's not.
Okay.
Not all plans offer it, but yes,
Correct.
most of them should have it.
Okay.
Now, as the name suggests, it basically gives you a benefit at certain life stages in the future.
Okay.
So one of the most significant ones being marriage and the others being the birth of your first and second child.
Okay.
So what the insurance company does is they expect you to buy term insurance at the start of your career when you're just
Correct.
21, 22. And that is what it should be, right? That's something
Correct.
that even we suggest.
Yeah.
So there you purchase whatever you're eligible for or whatever the suggestion is. And in the future, when you get married, you can contact them saying that, hey, look, I've now crossed this life stage. I wish to enhance my term insurance.
Okay.
So they have a limit of about 50 lakhs by which you can increase your cover amount.
Okay.
So essentially a 1 crore insurance, I can now make it 1.5 crore simply because I have another dependent on me.
Okay.
And two, in the future when I have kids, I can add another 25 lakhs.
Okay.
So essentially from 1 crore, over these 3 life stages, I can now have a 2 crore insurance.
Wow. Okay.
Now here, like I said, when you're buying the plan, you don't pay for this rider. It's just in the future, when you increase it for marriage.
Right.
Let's say I bought the insurance at 22 and I got married at 28.
Okay.
At 28-year-old, what were the prevalent premiums at that time? That's what I'll pay over and above for the 50 lakhs.
Understood. Okay.
And same for the birth of children as well. At
Correct.
30, 32, whenever that happens, I'll be paying that premium.
Understood.
So that will work out a bit more expensive, right?
Okay. So is that something we'd recommend at Ditto?
Not necessarily. Like I said, it's a free rider. So if it's in
Okay.
your plan, there's no harm.
Understood.
And two, once again, we recommend a cover factoring all of this in.
Okay.
Right? That look, in the future, your inflation, family size growing, everything is something we suggest you to factor in before you go for a plan.
Right. Right.
I think life stage only makes sense where, let's say, your income is still a bit low and you can't get too much insurance at the beginning.
Understood.
So that you take whatever you can, in the future you slowly increase it.
Understood.
That's one way to go about it.
All right.
Some companies have a simple top-up benefit saying that, look, contact us whenever you want and we'll just add another 1 crore to your insurance.
Understood. Okay.
This might be a bit better than life stage because I don't have to go through 3 different processes.
Yes.
Here it's one shot, another 1 crore.
Great. Okay.
So this again is not a bad suggestion.
Okay.
Some users also prefer directly purchasing another insurance.
Okay.
Rather than enhancing the existing one, they feel that, look, if I'm anyway going to pay fresh premiums at that time, why not just diversify and take another 1 crore from a different insurance company?
Okay.
Maybe I'll get some interesting features from there, or I
Correct.
could take a rider that I missed out on last time and so on.
Right.
So these are some of the approaches that most insured people go for.
Okay.
Enhance the existing cover through a life stage or a top-up, or
Okay.
you purchase another insurance, plain and simple.
Understood.
Yep.
Now, Sushant, in your experience as an advisor, can you just list out some common mistakes that people make when choosing the term coverage?
So I think there it firstly would start with the duration. Sometimes they take an insurance for a much longer duration, like let's say till the age of 85.
Okay.
That's the maximum most life insurance companies will allow.
Okay.
Now the problem here is most users take that thinking that, look, by 85 something will happen and my family will end up getting the money.
Right.
They're trying to look at this as a money back policy of sorts. The problem with that is, look, the insurer is also going to look at it from the same standpoint.
Correct.
That, look, life expectancy today might be around 70.
Right.
If you're buying it till 85, there's a very high chance something happens.
Correct.
And the chance of them paying out that lump sum increases significantly.
Correct.
So they're not going to give it to you at the reasonable premiums that you once thought, right? They
Right.
would double, triple your premiums just to
Yeah.
kind of mitigate their risk as well.
Correct.
So that's one of the first mistakes where we feel, look, buy it for just as long as you need it.
Correct.
At the end of the day, this is to secure your financial
Family.
dependence. So for as long as you have dependence, take it until then.
Okay.
Two, I think the mistake in terms of the cover amount, where they either say that, look, 1 crore is enough, it looks like, a good amount.
Correct.
And sure, 1 crore might look like a good amount today, but maybe 20 years later when your family actually needs it, it might be worth peanuts. So that way we do say that, look, do consider all options and factors before deciding how much term insurance you need.
Right.
While you might think that, hey, a 3 crore plan is going to cost me a lot, 30,000-40,000 in premiums, you have to consider that you're locking in the premiums.
Okay.
So 30,000-40,000 might seem like a bit today, but 5 years later your income is grown, your premium is still 30,000-40,000.
Right.
So it's really not going to pinch you that much, right?
Correct.
But you have done a good job at securing your family.
Correct. That's right.
So I think broadly it's just these two,
Okay.
choosing the wrong duration and not factoring in multiple things while choosing the cover amount.
Understood. Navigating through these nitty-gritties of the insurances can be a tricky thing, but we at Ditto can certainly help you. Don't forget to book a call with us with the link in the description. Thank you so much, Sushant. This has cleared a lot of air around how to choose the right term coverage. And folks, like always, like, share and subscribe. Happy insurance hunting.